Do not invest in the wrong stocks in 2024, and in today's episode we are going to discuss what we expect to unravel this year. We're going to look at what we see the Fed doing in 2024. We're going to run through what we believe the REITs, the financial real estate investment trusts, how they're going to be positioned versus the equities. We're going to take a look at how the S&P as a whole has been just over the last few days to understand if this gives us a signal of what we expect in 2024. And we will take a look at some of these companies, looking at their dividend safety, as well as analyzing based on dividend yield theory whether we see these as undervalued, overvalued, or essentially reasonably valued. We're going to go through a few different companies, and we will run a few of these through our valuation model, getting to the intrinsic value and acceptable buy price given our investor margin of safety, just to discuss whether or not certain industries are overvalued or whether we see some nice undervalued discounted stocks in industries as a whole. So let's jump in and discuss very briefly about the Fed. Now, as we can see in 2024, the Fed is expected to cut interest rates. And how can we prepare? Well, as we know, this will be the first cut the Fed will have done since essentially the early days of the COVID pandemic, going back several years now. And essentially the bonds and REITs industry are expected to benefit the most, although you can have essentially locking in very high rates of CDs right now. However, that does depend on what type of investor you are, how aggressive you want to be, or if you want to be more conservative. Now, interest rates will cut this year, and my prediction is that we will see the real estate investment trust really take off in 2024, and we have seen a part of that already in the market in the last few days. And I also do expect to see a rotation out of those tech stocks that had a phenomenal run in 2023, moving into other undervalued sectors like the healthcare sector as well as oil and gas, but we can go on about that when we look at the S&P map shortly. So in terms of the real estate investment trust, let's focus on that. We can see over the last 18 months, it has been very hard. We've reviewed many stocks: Realty Income, Vici, Public Storage, ADC, Triple N, a lot just to name. And we can see they have had a very, very poor year. But one thing that is interesting is looking back at history, and after the rate hike cycling ends, which we are expecting this year with a minimum of 3 cuts, REITs tend to perform well. Now, how do we know this? Well, we can look at the history, and what we can see based on this graph here are the returns of US REITs versus US equities. Now, what this shows, over the last 6 months before initial rate hikes, we see that REITs, in fact, don't perform that well in comparison, 3.3% versus equities at 8.1%. However, after the rate hikes finish, we can see the complete opposite, with REITs performing far better, 15.8% versus US equities at 8.4%. Now, this is purely history. It is comparing what happens on average, so it's not to say it will happen again once this cycle has officially ended, but it is interesting to note. And as we have mentioned through all of the videos we've looked at in the REIT sector, a lot of them do look significantly undervalued, and we will touch upon that shortly. So let's take a look and see how the S&P has been year to date. Yes, it is only a few years, but let's gauge whether or not we can see any patterns. Straight away, we see the big tech down significantly. We have Apple down over 5%. Now, we have recorded a video in detail if you want to watch that just a few days ago. We see these semiconductors that were on a phenomenal run in 2023. We have Avgo down 4.7%, Nvidia down 3.31%, AMD down nearly 8%, and it is, as you can see, a sector-wide issue in technology, in the semiconductors, and you can argue for the software and applications. Now, when we look at the flip side to see where has benefited the most, it does tend to be, as we can see, the healthcare sector. Eli Lilly up 8%, Johnson & Johnson up 3%, AbbVie up 3.5%, as you can see on the screen. And that also extends not only to the energy sector, but also to the utilities, as you can see. Now, this doesn't necessarily mean that this is going to be the pattern that follows over the next year, but it is something just to take a note of. Is this something that we're seeing in terms of the rotation? are investors, institutions moving out of companies that have run quite significantly well in 2023 into the healthcare stocks that we see here, into the energy and gas. And for those that have noted, you do see companies that do pay high dividends, as we see Verizon up 5.3%, AT&T up nearly 3%, the high yielding stocks. Something just to note, again, it isn't something that is going to happen in 2024, but it is interesting just to see this pattern, and we will update you over the next few weeks whether or not this is something that we continue to see in the investing world. Now, just for those that want to compare it to 2013 to see how well these companies did, as you can see, the technology significantly strong in terms of comparison to the other industries. Microsoft up 55%, we have Apple up 45%. But then when you do compare it to the sectors that are performing well, it is interesting to note those ones that we discussed. Verizon, okay, it was down 1%. We then have AT&T down 8%, both of which are performing very well. We have the healthcare sector, some performing well. You have Johnson & Johnson down 10%, AbbVie down 2%, Pfizer down 43%, and some of these have picked up well over the first few days. And the same does go for the energy and oil and gas, ExxonMobil, Chevron Corporation as well. And we can see the same here with the utilities. They didn't start off well in 2023, but they have looked to perform fairly decently in the first few days of 2024. So let's very briefly now look at some of these companies that we do believe to be well performing for 2024 and those that we believe will come down and cool off that run impressive that they had in 2023. So we'll just take a very quick look. These are companies that do have very safe dividends. We can see Chevron 90, Elevance Health 99, Pfizer 75, Realty Income 80, Microsoft 99, Apple 99, and Nvidia 89. So what we're going to do, we're not going to run through all of the financial metrics. We will specifically look at dividend yield theory, and then we will run into their valuation models, understanding what we believe their margin of safety is to be, just for a few select of them. So let's start off with Chevron Corporation. Now, dividend yield theory, it states that the company is undervalued when the current yield sits above the 5-year average. So what we can see here for Chevron is that it looks reasonably valued with that current yield at 3.96% versus the 5-year average. Forward PE, you could argue some undervaluation with it essentially being 11 below that 5-year average of 12.8. So Chevron itself, if we're looking specifically, does look to be reasonably valued. This is in the oil and gas sector, which we did see have a poor 2023, but has started off well in 2024. Then we look at Elevance Health in the healthcare industry. They have picked up quite well so far. And we can see here, again, it does look to be reasonably valued, 1.22% above the 5-year average of 1.19. And you can see a very similar story in terms of the forward PE, 13.6 versus 14. Now, when we look at Elevance Health, for example, in our valuation model, and as always, if you do enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you can continually be notified of these videos. Well, typically we run through every model, but for today's episode, we'll jump straight into the stock valuation final tab. We can see that we get an intrinsic value of $568. Now the current price at $486, we typically start off with a margin of safety of 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. So it is a buy up to 10%. If we move it to 15%, we can see it's a few dollars shy. So we see around 15% margin of safety for Elevance Health, which looks to have started the year fairly strong. In terms of Wall Street, well, we can see they see around 20% upside. So even Wall Street have positioned them where they see healthcare having a strong year. This isn't the only one where they see it having a 20% plus in terms of the foreseeable future gains. So 15% margin of safety for Elevance Health with 20% upside per Wall Street analysts. And then we move into another company which we also reviewed recently. We have Pfizer. Again, it has started off fairly well. Dividend safety score of 75. Now, when we look at that dividend yield theory, we can see that sign of undervaluation, but also do note the forward PE is sitting higher than the 5-year average. Likewise, similar to Elevance Health, when we do jump into the valuation model, we also see undervaluation, not only with Elevance Health, but also with Pfizer, with the intrinsic value coming to $36, and we can see that current price at $29. If we go to 10%, we can see it's undervalued, and at 50%, it's still around that undervaluation price, and at $20, a few cents shy. So with Pfizer, again, we see 20% margin of safety, and in terms of the upside, Wall Street see around 20% upside too. So 20% margin of safety, 20% upside. When we look in terms of the REITs and move away from the healthcare, we see a very similar story. Again, decent dividend safety for realty income. Again, we can see dividend yield theory showing that sign of undervaluation, that current yield above the 5-year average, as well as the forward P to AFFO sitting below that 5-year average of 18. When we move into the valuation model, there's no real surprise here, but again, this is one we have reviewed recently. It does show signs of undervaluation, and when we do look at that margin of safety at 10%, it is a buy up to $60. At 15%, we see a buy less than $1, so around 15% margin of safety. Wall Street, in terms of what they see, well, we can see around 15% upside. So for realty income, again, another REIT or a company, in fact, that hasn't performed well in 2013, we see a nice margin of safety as well as upside, and we can expect to see, based on the historical data, REITs do tend to perform well once those hikes have been finished. Now what we can do is the opposite, and we can look at companies that have performed very well in 2023, as we saw earlier on the heat map, and we can see how they look to be. And no surprise, but Microsoft seems to be overvalued. We see that dividend yield below the 5-year average, and we can also see the forward PE sitting above the 5-year average. When we then compare that essentially to the valuation model, we get to the intrinsic value, as always, with the average of the models used. And don't forget, you can click on that pinned comment below where you can grab a copy of the model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or those on your watch list. So we start off with a 10% margin of safety, and we can see 10% it wouldn't be the price right now. And then when we move to 5%, it still isn't at there. So you're not even getting a 5% margin of safety on Microsoft. But then when you do look at Wall Street analysts, we can see they are looking at around a 15 to 20% upside over the next 12 months. So it really depends whether or not you are satisfied with a 5% margin of safety. When we do move to the next company, we see Apple, again, another one, very strong performer in 2013. Based on dividend yield theory, again, another sign of overvaluation, and similarly seeing that same signal with the forward PE at 27.5 above the 5-year average. Then when we come to the Apple evaluation, we can take a look, and remember, hit that like button, smash it in fact, and subscribe and hit the bell if you do want to be continually notified of these videos as they drop. Now the margin of safety of Apple, we actually get around 10%. It is around $1 shy. It is very low also on the RSI, below 30. And when we look at Wall Street, we do see they do signal around 10% upside. So in fact, it is looking like a better stock in terms of margin of safety versus Microsoft, but still it has a very low MOS in comparison to those other ones that we do seem to be undervalued. And then we can look at Nvidia, which shows exactly the same. We can see here still very strong dividend safety, but even just looking purely on dividend yield theory, again, overvaluation when we look at the yield. However, we do note the forward PE is currently sitting lower than the 5-year average. So in conclusion, we do see and agree that we do expect those rate cuts to happen in 2024, and we do believe that REITs will be one of the benefactors of this. Also, given how the companies have performed in 2013 and what we are seeing now, when we look at just the year-to-date performance, I do believe we will see a rotation out of the semiconductors, out of the technology stocks that have had a phenomenal run in 2023, and we will see companies in the healthcare sector, as well as those that plummeted in 2023, energy, the utilities, as well as those real estate investment trusts, having a much better 2024 and returning a positive return. That's all my opinion, though. I would be interested to hear your thoughts. Do you agree, or do you see 2024 also being a strong year for the technology stocks? As always, let me know your thoughts in the comments below. Smash that like button if you've enjoyed today's slightly different episode, and do hit that subscribe and bell button if you want to be continually notified of these videos. As always, have a great day and catch you on the next episode.